It's really not just the fact that the housing market is flat here in Toronto. The Canadian economy looks shaky, and now you're hearing that Toronto rents are sliding quite a bit. So if you are a new real estate investor, it's definitely fair to wonder whether this is the right time to get in. But here's the thing, rents falling right now is exactly what you should expect. What's not normal is that home prices are still sliding too, and that's the real story. So in this video, I'm going to break down why rents are behaving the way they are, why prices aren't, and what this means if you are building or buying multiplexes in Toronto today. Let's start with rents. Yes, they are easing, but this isn't a crash. This is just how rental cycles work. Immigration has slowed, the job market isn't strong, and tenants are stretched. At the same time, new condo completions are flooding the rental pool with extra supply. More supply, less demand, and suddenly tenants have options. And when tenants have options, landlords lose leverage and rents come down, and this usually coincides with interest rate drops. And that is the rental cycle. During the pandemic, rates dropped, prices skyrocketed, and rents eased because more people can buy. And then rates spiked in 2022, prices fell, and rents exploded higher because renters locked out of home ownership and had no choice but to rent. Now that rates are easing again, rents softening is normal. And while the headlines focus on year-over-year rent declines, and it's still happening, the reality is that rents have actually stabilized since spring of 2025, which does confirm that this isn't a free fall, it's just the cycle playing out. But here's another twist. Prices aren't rebounding like they should. Normally at the stage when rates are lower, buyers rush back in and home prices come up. But right now, even though rates are coming down, prices are still sliding, and that is unusual. The rental side is behaving exactly like how it should be, but sales are not. Confidence is gone. Buyers don't believe we've hit the bottom. The economy looks like it's on the brink of a recession, and with speculation out of the market, listings are steady, but demand isn't rushing back in. So for the first time in a long time, we've got rates coming down, rents coming down year over year, and prices still falling. And that overlap doesn't happen too often. So what do you do with this as an investor? Well, we don't want you to panic about rents because they are moving the way they should. You should focus on what kind of units to build or buy that hold up best while rents are soft. 3-bedroom units are the most volatile. Families are stretched in a weak economy, and the tenant pool for 3 beds is smaller in general. 1 beds face the heaviest competition because almost all of the new condo supply are 1 beds. But 2 beds, that is actually the sweet spot. Dual income couple tenants who want work from home office space, need room for a dog or a nursery, and don't face the oversupply of 1 beds or the affordability squeeze of 3 beds. So let's make it real with a starter Toronto multiplex conversion project with our favorite setup, 3 2-bed units, the same type of property, the same reno in our go-to pockets, but 5 different years from 2021 to today. So you really see how cash flows and numbers have shifted over time. In the spring of 2021, starter multiplex projects in our favorite pockets were close to $1 million already. The saving grace was that mortgage rates sat at around 2% at this time, so cheap debt definitely helped cash flow push close to $1,000 a month. Keep in mind, triplexes were not allowed in most houses in Toronto yet, so 2-unit setups ended up making rents look weaker than 3 units. By spring of 2022, the market peaked. That same type of house was now worth $1.1 million, and fixed rates jumped to the mid 3%. Rents were rising, but debt costs spiked even faster, so cash flows were basically break even at this point. Now, after the peak in 2023, prices did cool quite a bit, coming down to closer to $925,000, but rates climbed even higher. The silver lining was that rents also spiked quite a bit, and so the mix of lower prices, higher rents nudged cash flow stronger than the 2 years before. Then that summer, Toronto opened its door to allow up to 4 units in low-rise homes. So by April of 2024, prices were flat, rates had ticked up higher, but rents kept climbing. And the ability to split a house into 3 units instead of 2 really made a big impact. And that ended up helping to offset the expensive debt and take cash flows much higher. Fast forward to spring of this year, 2025, rents did soften, but so did interest rates, which ended up canceling each other out. The big change was prices dropping even further, which helped to drive the best cash flow yet, close to $2,500 a month. And since spring of this year, not much has actually changed with rents or interest rates, but prices continue to slide, making the numbers better than ever. So here's the real takeaway. Rents falling is pretty normal. Rents stabilizing since spring just proves that we are still in a regular cycle. Prices still sliding even though interest rates are easing. That is not normal. And when the cycle breaks, that's when investors get their edge. So the question shouldn't be, is it a good time to invest in real estate in Toronto? But rather, what property setup will give me the strongest returns for my goals and budget? And that is what exactly we do here at Elevate every single day. We've done it for our own portfolios and for hundreds of clients as well. And we are a full service real estate sales brokerage here in Toronto, specializing in Toronto multiplex investing. We'll help you find the right deals, crunch the numbers, guide you through renovations, secure tenants, and even manage your property too. And if you are ready to get started, just head over to this link here and let's talk strategy.